Hi, and welcome to Policy Provisions. My name is Laura Armstrong from San Antonio, Texas. Now, Policy Provisions explains the rights and the responsibilities from both the policy owner and the insurance company. Now, some of the common provisions include the ownership rights, maintaining a policy in force, the beneficiaries, and the exclusions. Today, we will be specifically talking about maintaining the policy in force, which includes the premium payment clause, the grace period, automatic premium loans, and reinstatements. So let's take a look. Premium payment clause. This basically means that an insurance payment must be made to keep the coverage. Now, a policy will specify the mode or the frequency of the payment. Now, keep in mind, life insurance premiums are always paid in advance. This makes up the premium payment clause. Now we talk about the grace period. The grace period also protects the policy owner. It protects against unintentional lapse of a policy due to a missed payment. In a sense, a company will give the policy owner 30 or 31 days as specified in the contract for them to get a payment in. If the payment is due and not received from the insurance company, the grace period will kick in, which basically means they will have coverage for that period of time until a payment is made. So let's take a look at this example. Let's say a premium was due on March 1st and the payment was missed. The grace period would automatically begin. The grace period would last anywhere from 30 to 31 days as specified in the contract. In this example, it means that the grace period would last from March 1st until March 31st. Once April 1st hits, the policy would begin a whole new phase. Now, keep in mind, if a death were to occur during the grace period, a death benefit would still be payable to the beneficiary. The company would just simply subtract the missed premium. So the full intent of the grace period is to prevent unintentional lapse of a policy. Now, another provision that may be found in some whole life policies is called an automatic premium loan. This also maintains a policy in force if a payment was missed. Now, in this instance, the insurer will simply grab the money from the cash value to pay the premium. So it would keep the policy in force. Now, what happens when the grace period came and went, and we didn't have a whole life policy, so we didn't have an automatic premium loan? Well, then the policy would have simply lapsed or canceled. Now, if a policy owner wishes to put a policy back in force to how they originally had it, they could do what we call a reinstatement. Now, applying for reinstatement has a maximum time limit, which is typically 3 years from the time it lapsed. The policy owner would be required to pay back all missed premiums with interest. They would be required to pay back any outstanding loans plus interest, and also provide proof of insurability, which basically means they would have to prove that they qualify due to health. Now, once all this process is complete and approved by the insurance company, the policy will be back to original status. So in this segment, we've talked about all the provisions that keep a policy in force. So this is how it wraps everything together. We have the provision from the time a premium is due. If the payment is missed, the grace period would begin. If available, the automatic premium loan would start at that point if they had a whole life policy. And if all else fails, they could reinstate it to original status within 3 years. So in summary, we talked about the premium payment clause, the grace period, the automatic premium loans, and the reinstatement. Thank you so much for joining me in covering the provisions that maintain a policy in force, and I wish you the best of luck.